Hey guys, it's Mandy. Welcome back to my channel. So this video is finally the second video over owner financing. In this video, I wanted to just go a little bit more into detail on the technical aspects of owner financing. There are actually, depending on the state that you live in, there are actually two different ways that you can structure an owner financing deal. And so I just wanted to explain the differences there. And then I've also had a couple requests to go over the numbers on an owner financing deal. And so I wanted to do that as well. So first of all, I will just tell you, of course, I'm not an expert. I'm really not an expert in anything real estate related. I am learning as I go, and I'm just kind of making videos sharing what I learned. But the best advice that I can absolutely give you, if you are thinking about doing an owner financing deal, then I would go talk to the title company in your area. They do this kind of thing all day long. They really know what they're talking about, and in my experience, they have always been really happy to help and answer any questions that I have. In this video, I'm just going to go over the differences of the two types of owner financing deals, and that way you at least have some understanding, and maybe that will help you know what questions to ask the title company and know what you need to talk to them about. So basically you can do it either with a land contract or a contract for deed. You'll see those terms used interchangeably. It's just talking about the same thing. Now, using a contract for deed, that's not legal in every state. So in my state, in Arkansas, I can sell a property using a contract for deed, but in some states you cannot. The other way that you can owner finance a property is with a mortgage and a promissory note. That is what you normally think of when you think of going to the bank and getting a loan. It's basically the same thing, except instead of going through the bank, the seller is acting as the bank. The main difference between those two types is when the buyer gets the title to the property. So with a contract for deed, the buyer does not actually get the title to the property until all the payments have been made. So that title will be held in an escrow, and then once all the payments are made, then the title is given to the buyer. Because it's structured like this and the buyer doesn't actually have the title to the property, it makes it a lot easier to take back the property if the buyer defaults on payments. So you can actually just reclaim the property pretty easily, and you don't have to go through a foreclosure or anything like that. It's a lot cheaper and a lot easier to take back the property. Now, if you go the other route and you do a mortgage and a promissory note, then the buyer actually gets the title to the property right away. In this case, they actually own the property, the title is in their name, and you have loaned them the money to buy the property. So let's say it's a $50,000 property, and just for the sake of the numbers, let's say you didn't require any money down. So technically, you've loaned them $50,000 to buy the property, and they have to pay you back. Now, no money actually exchanged hands, but on paper, that's how it kind of works out, right? So now they owe you $50,000, and the promissory note will have all the terms for that loan repayment. It will have the interest rate, the term length, how much per month, and all of the information in regards to that loan repayment. Now, if the buyer defaults and they do not pay you back, then your loan's secured and you get to take the property back. However, it's a little bit harder to take the property back than it is with a land contract because the title's actually in the buyer's name. So you do have to go do a traditional foreclosure, you have to go to court and take the property back that way. So it is more expensive and more time consuming if the buyer were to default. So those two methods, most of the time the land contract is more attractive to the seller just because it's a lot easier to take the property back. And the mortgage and the promissory note, if the buyer knows the difference, which they may not, but if they know the difference, then that would be a little bit more attractive to them because there are more safeguards set in place and a little bit more hoops that have to be jumped through before the seller can just take the property back. So those are the primary differences between the two. There are, you can get really technical with it, but I would just encourage you to go talk to your title company, because all that's going to differ from state to state. So it would be really difficult for me to go into a ton of detail. And like I said, that contract for deed option, it may not be available in your state. It is in mine, but it's not available in a lot of states. So you may only be able to owner finance with the mortgage and the promissory note. Now, I have actually owner finance properties both ways, using a mortgage and using a contract for deed. And I'm currently leaning more towards the contract for deed. I prefer that just because I don't usually require very much of a down payment, since I'm just owner financing to tenants who have already rented from us for a number of years. So I don't usually require a down payment, and so it's a little more risky to do a mortgage where I may end up having to foreclose if things go wrong and having to spend $5,000 doing a foreclosure. But this year I've actually set up 2 owner financing deals. At the beginning of the year, I had 3 tenants come to me and ask if they could purchase the properties that they're renting. And I told all 3 tenants, yes, I would owner finance to them, let me get the terms together, and then we'll see if they're happy with those terms. 2 of the tenants said yes, they were happy and they wanted to buy the properties. 1 of the tenants said he was gonna wait to see what happened with the economy. So I said, yeah, that's fine. I'm always happy to just keep renting it. And actually, I would prefer to just keep renting the properties. I make more money that way in the long run, and I'm really in it for the long run. But at the same time, I do like owner financing the property, and it's not like I'm losing money that way. So I'm happy to do it either way, especially if the tenant has lived there for a long time and they've always made their payments, they've taken good care of the property. I do recognize that they feel like the property is their home, and I like being able to help people own homes. And so here's the numbers from one of those deals. I purchased the property in January for $39,000, but I borrowed the money to be able to do that, and once I pay it back, I will have $44,000 in the house. That is the initial purchase price of the property plus the interest from on the loan, the money that I borrowed to buy the house, right? And then on this particular house, I put in $6,500 of work, actually a little bit more than that, but that's a new septic tank, that is some new vinyl siding. It was just like a repair to the siding that was already there, so it wasn't all brand new siding, partially new siding, and a couple, I'm trying to look at all the costs. There were a few different like plumbing things. We replaced the kitchen faucet and redid the cabinet underneath, and then just a couple of valve repairs in the bathroom where the angle stop valves were leaking. And so that ended up being $6,500. The property is a 3-bedroom, 3-bath. It's 1,800 square feet. So that's a pretty big, a decent sized house for our area. It still does need some repairs. Actually, that property, if the tenants were to move out, I would go through, replace all the flooring and paint the inside of the house. And right now in this market, it would easily sell for $100,000. But it is in a little bit of rough shape. It definitely needs new floors throughout the house, which is something I'm not willing to do with the current tenants in place. They have just so many animals. We bought the property with the tenants already living there. I don't want to tell them they have to get rid of their animals or anything like that. I knew up front that they were interested in buying the property, so I just thought, I'll probably end up selling the property to them, even though I do really like the house and I have the potential to make more money on it if I don't owner finance to them, but that's okay. I'm not always in this for making every dollar possible. And so the terms that I agreed to with these tenants is that I would sell the property to them for $68,000 at 5% interest over 20 years. So that makes their monthly payment right under $450 a month, and they had been paying $600 in rent, which is below market. Rent has gone up a lot recently. That means I am collecting $5,388 a year for the next 20 years, which means that at the end of the 20 years, they will have ended up paying $107,000 for the property total. That's the principal plus the interest. That's the maximum they'll end up paying. They could actually pay off the loan faster. The minimum, of course, that they would pay would be $68,000 if they came up with the money right away to buy the house. I highly doubt that that will happen, and I actually doubt that they'll pay the house off early. Of all the owner financing deals that I have ever done and that my dad has ever done, we've only ever had one tenant pay off the house early. Everyone else has either paid off the property right on time or maybe a few months late. I'm happy to extend a few leniencies if they, you know, need to be a month or two behind. That doesn't make a big difference to me. I'm not gonna foreclose on someone just because they're 2 months behind on payments when they've paid, you know, for the house for 10 years already. So that's the deal. I think it's a good deal for me. I'm still making money, and it's basically guaranteed money. I'm not gonna have any big maintenance costs that may come up or anything like that. I don't have any headache of having to manage the property anymore. The tenants just send me money, or the buyers, they're not tenants anymore, the buyers just send me money every month and I just collect it. And I think it's a good deal for the tenants as well. Property values have increased a lot in our area in the last couple of years, and I do not expect them to go down. Rent has increased a ton as well, and I don't expect it to go down. Actually, a very large company just bought a huge warehouse in our town. It was like a $5 million warehouse, which is crazy numbers for our little tiny town. And the company is projected to add like 250 jobs over the next 4 years. And the local little community college is gonna have training programs for those jobs. And so that's a really big deal for our town. And I think that it'll keep real estate values up. So anyway, I hope that this video helped you guys understand owner financing a little better. Let me know if you have any more questions, and I'll see you next time. Bye.